You're listening to the Valley Current.
So let's use an example of kind of a typical situation these days that occurs in Silicon Valley all the time, which is a company gets started and the founders put in a little bit of cash and a lot of ideas and intellectual property. And they often go out and raise money on these SAFE agreements, these SAFEs, which is a sort of a hybrid form of agreement for future equity. Y Combinator innovated this document. It's not technically styled as a secured note. It's not styled as a convertible note. It's not styled as a promissory note at all. It's styled as an agreement that is designed to become equity at the point that there's a preferred stock financing sometime in the future. And sometimes the future is a very long period of time for some of these startups. So what actually happens if the company doesn't get, and this would be a standard Delaware C corporation, not an LLC, but I guess you could look at LLCs as well. But let's focus on the standard Delaware C corporation that basically has, they think, no creditors because they think, well, we have these SAFE agreements with, 10, 20 angels. They put in 50 to 100,000 apiece. Maybe it amounts to a couple of $1 million. But it's not equity and it's not debt. It's something hard to define. And then the company just goes bust. What's the state of affairs for those people that have those SAFE agreements when, say, there is some intellectual property, or there are some patents, or there is some software, or there is some prototypes? What's your experience dealing with that kind of situation where this Y Combinator innovation called an SAFE, agreement for future equity?
Yeah, so I think it really, Jack, comes down to how the agreement is drafted ultimately. And in terms of SAFE agreements, I think one of the issues that is still being worked out in the courts is that, like you mentioned, this is a very non-traditional type of financing arrangement. I mean, it's something that, as you mentioned, was invented basically by Y Combinator and is fairly recent. I think it was only invented really in the last 20 years or so.
Yeah, last 10 years probably. Last 10 years.
Yeah, exactly. So I think at some level the courts are still working that out. In terms of generally how I advise clients, it depends on how the agreement is drafted. So if you look at what a claim is in bankruptcy and what type of what types of general transactions with a debtor pre-bankruptcy would allow someone to claim money as a general unsecured creditor, for example, versus, let's say, not be able to claim money or only be able to claim as an equity holder, it will ultimately depend contractually on what the agreement says. If the court believes that it's more akin to maybe a convertible debenture, but where you have at some level a more debt or a financing arrangement more akin to debt that is convertible to equity at some future point, then I think you're probably going to have a stronger claim that you have a right to payment there. Because the argument will be, well, Your Honor, even if there never was ultimately a conversion or the company never went IPO or the company never sold, that would result in these preferred securities becoming convertible fully into equity, we still have a claim to payment on the basis of the debt component of the agreement. Whereas if it looks more like a pure investment in the company and that this is just more akin to an equity investment, than any kind of thing that would give you a right to payment, then it's more likely to be treated as equity. And my impression is that the courts are kind of still working that out as pertains to safe agreements, again, just because they're so new. But that may be something that will play out in our industry over the next 10 years or so and more.
Yeah, particularly if we're going through a recession or something worse in the next year or two, we're going to see a number of startups fail because a number of VCs are going to tighten their belts and say, we're not going to put into a speculative business something that is not necessarily going to get its next round of financing. I mean, it's a little bit like, the high tide raises all ships, but low tide kind of collapses a number of them, often the weakest ones. And so these angel investors that have, it's called a simple agreement for future equity, SAFE. And some people think it's more like a warrant or an option. Basically, you're buying an option to get equity on a future date, and the option doesn't necessarily have an interest component to it, although it could, and therefore it doesn't really have any aspects of being debt, depending, as you said, on how it's drafted. And I think a lot of those people, a lot of those quote unquote investors could become surprised because they may say, well, we thought the business was generating some collateral, and we thought that collateral ultimately would protect us. I mean, often these businesses don't have other debt. They just have essentially their common shareholders and a bunch of people waiting for a future financing round that presumably will be preferred stock. Now, for founders, this is a good approach because they don't want to be diluted. They don't want to have to deal with voting rights. They don't want to deal with shareholders. They don't want to hold shareholder meetings. They essentially want the money, but they don't want the obligations that are associated with either equity or debt. They want people to just wait for the opportunity to get into a deal that is priced based on some real preferred shareholder investor, typically a VC firm, that actually can see that the company is getting some traction. Now, another way to put that is, look, if you're doing a deal with a safe agreement, you are taking a highly risky investment and accepting that if the business fails, you probably won't get anything. But it's a little weird in a way that if the common shareholders are able somehow to divvy that up because they can just say, well, the safe agreement investors have zero, that seems wrong because it seems like the founders should be the last ones off the ship, right? In that scenario where there actually are some assets that Fortress or others would want to buy, whether they're patents or trade secrets or trademarks or domain names or copyrighted content or anything else that represents intellectual property that has tradable value, right?
Yeah, I think my perspective on that, Jack, is kind of like you mentioned, a lot of the people entering into these agreements are, hopefully at least, accredited investors. They are very savvy investors, one would think anyway, hopefully, and are hopefully familiar with safe agreements before they enter into them. And so at some level, I think, if you're talking about an informed investor who's going in, eyes wide open, and they know what the risks and potential rewards are, I think as a practical matter, I'm okay with that. As long as, everything is above board and disclosed fully, and the investors understand what they're getting into, whether that ends up being, an option for equity in the future, or more like a convertible debenture or some mixture of both, depending on how the agreement is drafted. I think I trust, contractually for accredited investors to know whether that investment is right for them. But I do agree that it needs to be fully disclosed and above board what those rights and obligations are.
Right. So when you just see a young company fail, I'm sure you've seen that often enough in the various cycles. how do you get your arms around the entire explaining in the first meeting, the entire process and what it's likely to cost? Because you get this all the time where a business is failing, the founder or founders, the team is getting fatigued. They feel challenged they've been turned down 29 times. Airbnb was turned down 29 times before it finally got a term sheet from a venture capital firm that did quite well as a result of Airbnb going public. But the founder or co-founder of the business tells a good story on his TED Talk about all the rejection letters they got. People thought it was crazy. No way would this succeed. It's the nuttiest thing in the world. And, there are lots of stories like that where, unfortunately, there never is a term sheet and the company does fail, and they need to be referred to someone like you who can essentially in the first meeting say, well, look, here's the information I need. This is what it's likely going to cost. This is what it means if you're doing a Chapter 11 in reorganization or you're doing a Chapter 7. I imagine most people want to believe somehow they can do some reorganization in Chapter 11 before they convert it into a Chapter 7. Now, I don't want to get into the weeds here because we'll lose a lot of our listeners, but just generically speaking, what do you tell those founders just in the first 5 minutes of the conversation? Because if they're seeing you, they're probably very close to saying, hey, we can see the end is near. We haven't paid our landlord for a long time. We can't pay the electric bill anymore. We're broke and no one wants to give us any more money. Dad and mom are saying no. Uncle Joe is saying no. We've taken everything out of our respective pension accounts. We don't see a white knight. We'd love if Fortress would wake up and smell the coffee here, but they've ignored us. What do you say to them when they come to you with that kind of dire straits approach? Because often they don't have any cash available to even enable you to pay the filing fee, I would imagine, in some cases at least, right?
It just really is context dependent, Jack, and each individual client will have a different story. But as a broad matter, generally in the initial consult, what I'll first try and do is flesh out with a new client over sometimes even up to 2 hours or so. The initial consultation will generally talk about the company, what it does or did if it's already been shut down. And we'll talk about the assets of the company, its liabilities, its income, if any, its expenses, if any, what is going on for the company. Does it have the ability to operate at a profit? And is it more concerned about, maybe a watershed litigation or something like that? Or is it in a situation where it can't operate profitably? And the advice is different for each client, dependent on the answers to each of those questions and how those items are fleshed out. I would say as a broad matter, Jack, most of my corporate clients, even if they're facing liquidation, bankruptcy, are not utterly and completely without cash. Many of them have, cash that is insufficient to meet their liabilities and to operate, but that doesn't necessarily mean that they have no money whatsoever. So generally in a corporate bankruptcy context, the company would pay its own legal fees and costs. Occasionally, depending on the circumstance, especially for closely held corporations, there will be, a founder or, an investor that will front the money for the company to file bankruptcy. But usually the company pays its own fees and costs. And, it can be a really wide range, like you said, depending on the facts and circumstances. If it's a really, straightforward liquidation bankruptcy for a company that is not necessarily operating anymore and has failed and has, pretty simple assets and liabilities, you're probably talking, less than 10,000 in cost in terms of Chapter 7 liquidation cost.
No, but legal fees will be more, right?
No, generally for a company that would be, is not operating and, may only have a couple of creditors or not a lot of assets and just, definitely like sub, 3, 4, 500,000 in liabilities. Generally 10,000 or less in terms of legal fees and costs is pretty viable.
To just liquidate the company and get a final discharge order that says, okay, the assets that were available were sold and creditors were paid at whatever 10 cents on the dollar that was available from that distribution.
Yeah, well, in a corporate bankruptcy case, we wouldn't have any discharge order since companies don't receive a discharge, but we would get something sort of similar for companies in the sense that there would be an order closing the case.
Okay.
And then the order closing the case would mean that the trustee has fully administered the case and the case is now closed, which means all the assets that were available for creditors were liquidated and paid out to them. And then, of course, it goes up from there. So, if you're talking about companies that have, assets and liabilities in the millions or even tens of millions, then, you'd probably go, 10, 20, 30,000, depending on what exists in the case and if there are complex issues in the case. I would say that really from a cost perspective for most companies, what the board and the founders should actually mostly consider. I feel that most of the cost of a corporate bankruptcy case is actually generally not in the filing itself, particularly in Chapter 7. It's on the bankruptcy litigation side in terms of, is anybody going to oppose the bankruptcy or argue that there's been fraud? Or argue that there are assets that the trustee should go after that, may be subject to a fraudulent transfer or preference claim. The trustee will very likely pursue those, but if the trustee doesn't and a creditor wants to, those are the things that really sometimes add cost to a case and that the founders or investors, the board, should consider in terms of a liquidation bankruptcy. In terms of reorganization bankruptcy, generally, I would say it's a rare case in which Chapter 11 bankruptcy makes sense for a company that is under, let's say, 5 million in assets and liabilities. I won't say never, but generally it's a rare case when that is advisable. And I think, taking off my attorney hat for a moment and putting on my business person hat, the reason is actually not legal, but just practical, in that Chapter 11 is just so much time and effort to prosecute, both for the client and the client's officers. I mean, just dozens, it could be even hundreds, thousands of hours even of time, depending on the complexity and what's involved. And often you're looking at like hundreds of hours of attorney time to prosecute the Chapter 11 and get a confirmed plan. That really, if a company is not very, very strong and operating and really cash flowing quite a bit, or has some kind of asset sale or patent sale, something that's going to really finance that type of attorney work product. Unfortunately, I see a lot of Chapter 11s where the client will hire a bankruptcy attorney to do an 11, and they'll deposit a retainer to Chapter 11 attorney who says, oh, sure, I'll help you. And they think that the retainer is going to cover the whole case to confirmation, and they're blown away when it doesn't even come close to the total cost of the case. And that's why with my clients, I always feel it's very important to be totally upfront as to, look, I can represent you. This is going to be the retainer that I might charge you. but just for your own information, this is what I've seen this go until confirmation or to trial. These are what these things could look like before we're done with it, because I feel very strongly that the client needs to know that data in advance to make an informed choice.
Right. I mean, there are individuals that file Chapter 11s as well. Is the same thing true for them?
It is absolutely, Jack. And I mean, it's good that you mentioned that, because a lot of lay people, I think, view Chapter 11 as only for businesses. Not necessarily the case. There are some high net worth, or formerly high net worth, I guess you could say, individuals that have very significant liabilities. Some of them still may have significant assets even, because you don't necessarily have to be insolvent to file Chapter 11. You can reorganize even if you're solvent, actually. However, Chapter 11 is definitely pretty much only for situations in which either an individual or a married couple has very significant assets and liabilities, usually in the several million range or higher, just due to the cost and complexity of the case.
Right. So when you see this team of people and they say, look, we're just a startup, we've just done a lot of R&D, we thought we were going to get to the point of manufacturing a prototype. Unfortunately, we needed a lot more cash to get there. We've got a lot of patents, we've got a lot of potential, we've got a lot of designs, we've got a lot of this, we got a lot of that, but we don't have any customers, we don't have any cash flow, we don't have anything yet that actually can produce a product. We really need a big company to come in and sort of sweep up the team and take everything that we have and productize it. You know, we need essentially a foundry to take our design for the next, great electric vehicle. For example, Tesla should come in and take our prototype and so on. I mean, I'm making that up, but just conceptually, there are some startups that are really doing some interesting stuff, but they often don't realize just how much capital it takes to get from ground zero to success. I mean, it takes a lot of capital and often over several rounds, and that means you got to show a lot of progress to VCs. And when the investing environment changes, as it seems to be changed now and certainly continues to be changing, it's not like that capital is available. So then you get to, well, what do we have? We have, 100 patents, a few trademarks, some websites, blah, 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 team. Some companies should come in and scoop us up. But of course, those companies often think, why should I scoop you up? You're all going to fail. And then I'll just cherry pick the best engineers and have those best engineers join me and start over again. I mean, that does happen in Silicon Valley because of the freedom of mobility under Business and Professions Code 16600, and the fact that we don't allow non-competes in California. And it looks like the FTC is now saying maybe nationally employment non-compete should not be allowed. So I'm just kind of, from a national point of view. So I'm just kind of curious, like, how do you deal with a typical failing startup that tells you that story? Because they want to believe they can buy some time, stave off lawsuits, stave off collection actions, maybe even stave off their landlord. But it doesn't sound like that's a realistic outcome in a situation like that, right?
Yeah, I mean, I would tend to agree, Jack. It's all fact dependent, but that said, is a broad matter. If a company really just believes their IP is value, they've never operated, they have no customers, it's kind of in this inception phase, if you will. It almost never makes sense to file a Chapter 11 reorganization at that point. And whether or not a Chapter 7 would be a good idea for the board or investors to consider, creditors to consider, really depends on the facts of the situation. So generally, what I advise my clients to do is if it's a situation where you think that at some point you could sell the company, pay everyone off, and create something for equity, and your creditors are limited in number and are generally willing to work with you. So in other words, you might have 1 or 2 or 3, 5 creditors, and they say, okay, we'll give you time to work something out. You owe us, but we're willing to work with you, try and sell the company. What I generally advise my clients is, by all means, go try. There's, if the creditors are such that they are cooperative, work something out with them. Enter into some deferment agreements. Maybe they amend the agreements with each investor or creditor to provide them additional time, and wonderful. I think the issue where bankruptcy becomes more of something to consider is where you have 1 or more recalcitrant creditors that will not cooperate with any kind of amendment, deferral. They want their money, they want it now, and they would prefer the company to just liquidate rather than try and sell itself. It's really in that situation where founders should consider either an ABC or a bankruptcy. And like I always tell my clients, if it turns out that we filed the Chapter 7 and you are able to sell the business, you find a buyer for enough money to pay all the creditors off, once the bankruptcy is filed, they do have to pay the administrative fees of the Chapter 7 trustee. But if they can do that and still create money for equity, wonderful. I mean, they can. It doesn't foreclose that option. It just merely adds a trustee administrative cost, unfortunately, to that. But they do still get the benefit of the automatic stay. And, if that's relevant to prevent like a levy of accounts or, some sort of creditor enforcement action that would be disadvantageous to both other debt holders and equity holders, the bankruptcy could still stop that. The only consideration is that in Chapter 7, generally, it's the case that you can't continue to operate the business, unlike in a Chapter 11 context. So if part of the value of the company is operating, that could be a problem. But, for a client in the inception phase, like you're talking about, they're not operating anyway.
Right.
So it really doesn't matter for them. So I think, while it's always going to be fact dependent for each client, that's something whereby if someone wants to do an initial consult with me, I could run through those elements with the founders or the CEO, the officers, and really give them my best advice on how to proceed.
Right. I mean, it's like we're going to see more and more of these situations where maybe you can negotiate, maybe you can't. Obviously, the threat of bankruptcy creates some incentives to do some workout arrangements. At the same time, the reality is there often is not a white knight readily available. And oftentimes the founders and the team want to believe, well, if we just had a little bit more time, doors would open. If we just could get a little bit more runway. And they do a number of things, including getting employees to agree to accept stock or stock options or other sort of non-monetary compensation, whether that's legal or not under the California Labor Code and the federal minimum wage. We'll leave to some separate footnote discussions. But basically, they sometimes will get people to agree to work without current compensation because they want to see the team succeed. Look, Apple Computer, which is one of the most highly valued enterprises in the world on the stock exchange, it was pretty close to running out of money at the time that Microsoft became their white knight, 20, 25, maybe it was 30 years ago. People don't remember that. I mean, the company was in trouble, and Microsoft came to their rescue, surprisingly, because you could argue Microsoft was a competitor. I think that story is also true with respect to Tesla, there was a period of time when Tesla only had a month or two of runway for their payroll, and they were in deep financial trouble. And luckily, they were able to pull the rudder up and get out of it. But they're a very successful company, albeit the stock hasn't done so well lately. But Twitter is another example. I mean, look, the shareholders all got paid as a result of the deal taking it private for $44 billion. But it's got some financial problems, and Musk has announced that they may end up having to file for bankruptcy if they can't turn it around. That seems crazy, given how much money was paid so recently. But conceptually, these companies do have their ups and downs, and oftentimes they don't have ginormous war chests of cash to deal with problems. Although I think Tim Cook has actually compiled quite a war chest of cash for Apple. So Apple should be just fine throughout whatever period we're going through here. And maybe there's lots of opportunities for Apple to scoop up a number of these companies that are technology rich but cash poor at bargain basement prices. But we'll see whether that's the case. I mean, I think that's the era that we may be coming into, and founders often want to believe that those are easy deals to do, but they're not. They're not easy deals to do.
Yeah, I think that's 100% accurate, Jack. I mean, there are, whether it's Twitter or other large companies like Apple and Tesla that have had problems in the past but are now doing very well. There are a lot of companies that they come close. I mean, like you said, I think Elon Musk had said that Tesla at one point was, like you said, basically bankrupt. I mean, any moment. And they pulled a rabbit out of the hat, and now are a very successful company. And Apple, the same deal. I mean, in the 1990s, Apple, I remember thinking as an investor that there was no question Apple was going bankrupt. And then they came out with the iPod, and then later the iPhone, and the music store, and the App Store.
The iPad.
Mm-hmm. You got it. Yeah. And now they're, I think, still possibly the highest market cap company ever in existence, either Apple or Google, I think. But I think might be Apple. And,
yeah, I think Apple got above a certain number of trillions of dollars. I mean, look,
yeah.
Fenwick and West we were the incorporating lawyers for Apple at the start of its formation. So, we remember when it was just a tiny group. It's over $2 trillion in market cap today.
Yeah.
Historically, big oil like Exxon, Microsoft is 1.7 trillion today, and big oil has typically been the most highly valued XOM for Exxon, and Exxon's market cap is nowhere near the market cap of Apple. Exxon is at like $500 billion. Yep. So I don't know what the second largest company, it might be Tesla, or it was Tesla for some period of time. I don't know if it is at this point, because Tesla has taken some hits, but Tesla was up there in the trillions as well. But I think it lost a lot of its value over this, sort of Twitter controversy, or this Twitter devaluation, whatever you want to call it. It's certainly taken a hit for Elon Musk personally, and of course, some of his shares are collateral for the loans that he got, that he put money into Twitter to pull off this acquisition. So there's a complicated, interrelated story here involving his personal wealth. I'm sure someone will eventually do the detailed story on it once the dust clears. So, Zach, thanks for spending time with me. I really appreciate it. I think this was a good overview of your practice in personal, corporate, and bankruptcy litigation. You've got a great website. people can reach it at novalawgroup.com. Do you prefer that they just phone you, or how do you prefer that people reach you? What's the typical best way for interested clients or potential clients to reach you to talk further about the kinds of services you give in this area?
So, Jack, I'm open to phone, email, whatever the client would prefer. If they go to Contact Nova, they can see our phone number and email address there, and they're welcome to contact me however they please. Generally speaking, phone is probably easier to conduct the initial consultation. So typically I advise clients to just call me if they'd like.
And what number is that? What number would they reach you at?
Oh, just the mobile number listed on my site, but it's 650-814-8090 is my direct line. And basically they're welcome to give me a call. And we are one of very few firms that I keep office hours 9 a.m. until 9 p.m.
Wow.
Monday through Friday. So people can feel free to call me in the evenings after work, and it's not a problem. I take client calls all the time in the evening.
Wow, Zach, you're amazing. I didn't know that about you. Do you work 7 days a week as well?
I do work 7 days a week, but on the weekends only by appointment generally. So I promise I do take time off.
but 12 hours a day, I mean, that's like minimum 60 hours a week. And I guess you might say it might be more like, 7 times 12 is what, 84 hours a week. I mean, you're a hustler, man. I got to congratulate you. I mean, I remember when I did those kinds of hours, but it was not something I advertised.
Oh, no, I get it, Jack. I mean, I promise I do take time off. On the weekends, I try and be available to my clients as much as possible, but I do take time off, and it's generally mostly by appointment. So,
well, I want to congratulate you because you're an entrepreneur. You created your own firm. You've grown your own firm. You've been in this area for over 14 years. And I know, because I've referred clients to you and I've worked with you, that you're very diligent and very comprehensive and very efficient at what you do. And the bankruptcy judges, both in San Jose and San Francisco, and you know how to do these cases. So I want to congratulate you on getting to your 14th anniversary, and I look forward to working with you.
Oh, thank you, Jack. I mean, as always, I'm happy to be of assistance to your clients, as always. And congratulations to yourself. I mean, Computer Law Group has been around for literally decades. So
right, we've been around for a long time, and we like to think that we'll be around forever. We're all getting older, so we're also realizing that just isn't in the cards. You only get. In fact, there's a good book I just started reading called 4,000 Weeks, and it makes the argument that you should put up a chart that makes every day and every week, basically there's 50 weeks in a year, and, you usually can't imagine actively working for more than 80 years, and most people can't even imagine living for more than 80 years, but people are living to 100. So pretend like you can actually work. I mean, I like to say that it really should be titled 5,000 Weeks, and it really should be about making it to a healthy 100 years. But the book is called 4,000 Weeks, and it's more about looking at your life as essentially 4,000 weeks of time. And, if you're able to practice something professionally like law, medicine, dentistry, whatever, for a good portion of that 4,000 weeks, you're providing an amazing amount of services. I don't think we think about doing it the way you do it from 9 a.m. to 9 p.m., but you could say that's another dimension to the chart. And it's sort of like saying you only have a certain number of waking hours. I mean, we all have to get some sleep and some relaxation and some exercise. So there is a certain time dimension to all this. And the point is, when you've been in practice for over 40 years, you do gain some substantial wisdom, and hopefully you're able to express it to your clients in a way that will save them time and money, because that's really what service represents, a way to save people from having a loss of money or a loss of time or a loss of health even, because in many ways these are highly stressful situations that we're called upon to provide some help. So you've done a great job. I want to congratulate you and thank you for coming on.
Oh, for sure, Jack. And thank you so much for having me on. This was a treat, and it was wonderful to see you as always. And thank you so much for having me on your podcast.
Okay. Thanks, Zach. Talk to you later. Bye-bye.
All right.
Tune in next time on The Valley Current.